Hey there, welcome to the channel. So, gee, what a mess today was. We got Putin moving into Ukraine. And I think I just make a comment on that, clearly, what I was thinking before was, there is some legitimate security concerns about the spread of NATO into former, Soviet bloc countries and but it is very clear that this invasion is this is a full on invasion. I mean, attacking east west, the whole thing around the capital. I mean, just the whole darn country. So this has nothing to do with the breakaway regions. This has nothing to do with um something to security to negotiate anything. This is just full on, like going full, like I was saying in my other video, full KGB. So, this really is on Putin. He is gone like over the top with this thing, and it's horrible and it's sad and it's a disaster. So, I mean, even at this point, I'm like, I don't know. I mean, the consequence of this is pretty big because it's like, okay, I mean, this guy, he's looking to take and break the whole thing up or take the whole thing over. Wow, it's just going to be a huge mess. Okay, well, enough of that for now. So my thoughts and prayers go out to everyone in the Ukraine. It's just terrible. Okay, so let's talk about what happened in the market today. So here we have the S&P 500. Man, just a huge bar. I mean, this thing started gap down, just a huge reversal bar on this, and it's just actually quite incredible. Let's look at the Nasdaq. Similar on the Nasdaq here, even things like IWM. Really big bar. Interesting on IWM, kind of set up for a W here on IWM. I mean, really on everything. You're looking at like potential W for a lot of this stuff. Now, this is interesting. This bar here is called a bullish engulfing. It's a case where you go down, you open up gap down from the previous and then charge all the way through it. So that's a bullish engulfing on the RK. Really incredible. But one of the things that wanted to talk about today was trying to compare why this market went up today. Like, I don't know why, and it's really hard, but there is some precedence for this. So there tends to be so let's go ahead and look at other cases where war has broken out, and let's try to compare and contrast with those cases with the current situation that we're in to try to see if we can get some explanation as to what goes on. So first, I'm going to go to the first Gulf War. In the first Gulf War, this was back in 1990. And so what happened was on August 2nd, 1990, Iraq invaded Kuwait. Okay, so that all happened. And then for almost like a half a year, we looking at the market at that time. So that's in red. And then we see that the market kind of goes down and kind of hangs out and doesn't go anywhere. And then basically at some point, the US we decide that we're going to go in. So on January 16th, right here in this area of this green line, we start the air war and then followed up by the ground war. So you can see that when the war went hot, boom, the market just comes right out, and then it just comes out and it just returns to its previous uptrend. So there we go. We have a particular case of the first Gulf War where the stock market responded by going up. And it went up when the war went kinetic, when the war went hot. It was at that point where the air war started. Now, why would that be? It's very difficult to say, but in one way, you could say, well, okay, the decision is made. There's going to be a war. It's happening. The uncertainty is removed. We know what's happening. That's what's going on. So maybe that's what's going on today. So let's see. Now let's look at the second Gulf War. Here we are. This was started on 19 March 2003, right around in this range. And once again, we have a similar thing. We have these very large up days, and then in this case, the market kind of came out and continued its uptrend, and really actually started. I'm sorry, in this case, started a new uptrend. So we have like two cases now where the start of a kinetic war led to the stock market going up. So let's zoom out. Second Gulf War, 03. Where this arrow is, that's when the war started. Couple things. First of all, in 2003, the second Gulf War, one of the situations that happened here is we were in a bear market. Look at that time, we were in a very significant bear market for over a year. We had the tech bust up here, and in 2000, tech bust, And then we had this, bear market going on. And then we had the tax, September 11th attack. So we had that getting just beat up. And it was all the way back here into late 02 and 03, where we're finally kind of making this huge base. And then you can see that, okay, Gulf War gets declared, boom, and it goes. So my point is, in that particular time, second Gulf War, we were already in a bear market. We already had a bear market for 2 to 3 years at that time. Okay. So where are we at now? We're in a different situation right now. Maintain. We're in a like a 20-year long bull market, and we're at maybe the end of it, or maybe a transition, or just a consolidation period, but where it's a little bit different time. Now, let's go back to the first Gulf War. If we go here, I think I had, let's see. Nope. Okay. So the first Gulf War, one thing to kind of keep in mind here in this one is as well was that at this time of the first Gulf War here, try to put this all together. Okay. Yeah. What happened is, look back over here. Over here, what happened was we had this, the 87 crash. So you had this 20% crash in one day. And then from there, we were in a bull market, just kind of kept going up. And then here is the period of the disruption of the Gulf War, and we returned to that. So in one way, this is a nascent bull market. This is a bull market that, yes, been running for 3 years at that time, but it hadn't been running for 20 years. And I don't know where the inflation was. It was like, remember, inflation is coming down at this time because you've already had Volcker go in there and do the thing with the interest rates and all that crap. So yeah, interest rates are much higher than they were now, but they're on the downtrend. Okay. They were on the way to breaking the back of inflation. So now, and the other thing to keep in mind about these were in Iraq. So this is a kind of different kind of situation. So where are we at today then? So today what we have is we have this situation, go to the daily chart. We are in a bull market and we are transitioning to a bear market is what I'm speculating, but it's not official at this point in terms of like what has really happened. But the point is, we've been in this market that's been running up for years. And then what we can do is we can go out even further. And if we look out even further in really the big picture here, when you look at the big picture here, since 2009, back here, since 2009, really in this whole time, yeah, we've had some consolidation. You've had some pullbacks here. Even this is just a pullback. None of that interrupted the trend. You've basically been in a bull market since 2009 to 2022. This is a historic bull market. You're talking 13-year bull market. And now the question is, are we at the end of that bull market? I don't know. But it's very different than the other situations. Gulf War I, we were like, okay, we're nascent bull market, a couple of years of like coming in, and we're coming out of, the 20% market crash of the 87 crash. Gulf War II, the situation there, hey, we were in a 1.5 year long bear market at that point, and we finally bottomed out after the tech crash and then the September 11th attacks. So we're in a very different situation. And the situation is different in a couple different ways. First of all, we've been in this long bull market, okay? So that's different compared to the other two Gulf Wars. Secondly, we have very high inflation right now. Okay, we had higher inflation in the 90s, right? We at that point, we can go look at that chart and figure out where we were at, but we were on the downside of it. We had the high inflation of the 70s and the 80s. There was all those moves made by Volcker to like really crush inflation. And so in the 90s, we were like coming out of that. And in many ways, that kind of leads to why we had such a bull market in the 90s, is because look, they had finally, rates were on their way down. They were done crushing inflation. So all that was pushing and pushing. The difference, and one of the difference now, both those were against Iraq. What is Iraq's importance in the scheme of the thing of the world? Nothing. They had no trade with anyone. They're just not relevant. The only thing is they're an oil producer. Okay, fine. But compared to Saudi Arabia and the rest of the Gulf states, it's just not relevant. The rest of the Gulf states can make up for all that overall. So I think it's very important that this is very different. Comparing a war with Iraq to war with Russia in Ukraine, it's a very different situation. The Europe is very reliant on their natural gas and energy from Russia. And, all that's going to get cut off right now. And it's going to be an interesting thing to see. So in summary, we can see precedent for why the market would go up. And there definitely is some precedent for that. Because in the past, once there's been uncertainty about this, is this actually going to happen? Is there going to be a war in Ukraine? And now it's like, okay, no, it's clear. There's a war in Ukraine and it's a serious one. But the other side of the coin, how long is this going to last? Because this isn't really relieving any of the stress. At the same time that, okay, now we know this war is going to happen. There's no uncertainty there. You have very high oil prices. Now, of course, oil spiked and then it reversed. Same with like things like gold and stuff like that. But it's not quite over. It's definitely, we've had this impulse response, but it doesn't necessarily mean it's over. I mean, the natural gas, like Nord Stream 2 is shut off for now. You have all the pipelines going through Ukraine. I mean, I assume they're going to get shut off at some point. Hopefully they don't get blown up, but they could get blown up. So Europe could be in a really difficult situation. And, as I was pointing out in my earlier video on this, I was like, Putin has to go now. And that's why I was thinking that, because he's like, okay, this adds pressure to Europe. Europe is like, okay, what are we going to do? We're going to have high natural gas prices. We're going to maybe even not have enough. This could be just really brutal in that regard. So as I would say, I think it's different this time. That's really my conclusion. And this is not financial advice, but I think it is different this time because I think this is much bigger. This goes back to something that much bigger. It's bigger than the Gulf Wars. It's bigger than the wars in the Middle East that the U.S. had. And, and remember, that was the U.S. like being aggressive. Now it's something very different. It's Russia being aggressive. So the entire West has to kind of deal with this and figure out what it's going to do. So I think that explains, that helps explain why there is a precedent for the market going up like this. Will it be different this time? Will this thing be, basically, I mean, this could very well. I mean, there's an argument to say that, hey, this could have been the end of the correction. We had this correction because of increasing interest rates, all these other things, and maybe it just starts working its way back and we return on trend. My counter, though, to that is that what about inflation? We still have the inflation there. So what are we going to do about inflation? Also, inflation, interest rates, what are we going to do about that? Inflation now is being pushed up because of oil and commodities. Even though they reversed today, I mean, oil prices it could very well skyrocket even more. And that's going to put more pressure on inflation. So now it's funny, if you thought that the Fed was going to back off and they were like going to, instead of doing a 50 basis point raise in March, they'd only do 25 because they got to settle things. Maybe they'll do a whole 100 basis points. I mean, maybe that's what they should do. And either because look, the prices, remember the producer price index has not peaked yet. And we need that to peak first, then for that to show up in the consumer price. The cost of things going into consumer products has to peak and roll over first. As a curve, here's your producer pricing. And then at some point after that, it would free things up so that your consumer pricing can then peak out later, right? So that's kind of where we're at right now. So I really can't explain what happened in the market today in terms of why that happened. It's a very interesting thing. Very interesting. And the question is this a low? Is this the opportunity? And that's what I can't figure out. My gut feeling says, no, this is kind of a fake out, whatever. But just looking at a bar like that, a follow through day like that, I don't know. It looks pretty good. So we'll see about that. So I think that covers it for this episode. And we will have to see what happens. All right. That's it.